Most financial advice sucks. The incentives are just all wrong. I know because I've seen how they stack up, and once you actually see what the fees cost you over time, you won't unsee it. There's a great quote from J.L. Collins. If you know enough to judge whether a financial advisor is a good one, you probably don't need one. But you need to know how the fee structure works. A couple of ways this happens, and one is a flat fee. You pay up front, get a plan, go execute. That's generally what I recommend. This can be quite expensive though. 2. Funds under management. They take a percentage of your portfolio forever. The problem? It takes no more effort to manage $1 million than it does 2, but they get paid double. Also, that point that they get paid, that is not compounding for you. That is compounding for them. But the advice is often generic, conservative, slow, and worst case, more lucrative for them than for you. Advisors don't benefit from you taking big swings. Sometimes the safe way is the doomed to fail way. For example, high interest savings account. Very safe, right? Well, when you factor in inflation, there's a 100% likelihood of you going backwards. Safer advice also results in fewer complaints and less liability for them. Doesn't mean you can get the best return. However, some volatility is good because it's the fee you pay for better returns and compounding over time. They don't want you to pack up scared when the market turns bad though, so they're more likely to play it a little bit safe and put some money aside to hedge those downsides. The products and structures often generate fees, and sometimes a financial product may look great, but its complexity means that the fees are higher, which eat into your compounding. And some advice is just sales in disguise. Now, financial advisory is regulated in a lot of places and can't work for commission on most products. However, there are cases where if they're a fund under management model, they will select products that service that and allow the funds under management. And not every product supports this. So, you're limited to the ones that can fit the preferred model of the advisor. Look, if financial advisors were so good at making money, then why aren't they the richest people you know? I've met plenty of rich people, and not a lot of them are financial advisors. Don't get me wrong, they get a seat at the table, but they're rarely at the head. At the end of the day, you're paying their salary. I heard a story the other day that said someone in finance was hiring a money manager. They made a point to ask them, how do you invest your money? And they started to say what they recommend to people and what they recommend is the best structure. But the hiring partner said, no. Like, what do you invest in? Most of the time, what they invest in isn't what they sign you up for. Now, why is this bad for you? Because it can lock you into over-diversified or under-diversified, overcomplicated, and underperforming funds with fees that erode your compounding returns over time. So here's my nuance. Good financial advisors do exist and are necessary for complex structures, estate planning, sometimes behavior control, and particularly high net worth individuals and entities like family trusts, etc. But it's like going to the doctor to ask how to get in shape. They might offer you a pill when all you need is to eat less and move more. So what do I actually recommend? Well, maximize your earning for a start. You'll never get ahead if you earn 3/5 of not much. Spend less than you earn. This applies no matter how much money you have or how much money you earn. Avoid consumer and high interest debt, car loans, personal loans, and paying minimum amounts off you on your credit card. If you can't afford it cash, you can't afford it. Invest consistently for the long term. The best performing brokerage accounts are deceased estate accounts, forgotten passwords/lost accounts. This tells you that the more tinkering you do, the less better off you are, especially when you look at transaction fees and management fees. Most people don't need better advice. They need a little bit of knowledge and better execution. Also, they suffer from a thing called the professional bias. Now, this is where you go to them, and let's say you're doing okay, which you probably are if you're going to a financial advisor, you've got a high salary, you're ticking along, you've got a good savings rate, you've got some investments, and because you've come to them specifically looking for advice, are they going to turn around and say, hey, things look good, you're going well, just crack on, you'll be fine? Or are they going to be like, well, actually, in my expert opinion, I think we can tinker here, we can get you some of this, we can diversify some of that and offset some of this risk and hedge that. And then at the end of the day, you might actually not be better off because, as I said, that's going to increase fees and complexity. At the end of the day, they can be useful, but a little bit of knowledge and a lot of execution goes a long way. 2 books I recommend for anyone wanting to build their net worth without exorbitant fees are Simple Path to Wealth by J.L. Collins and Psychology of Money by Morgan Housel. But for most people, a simple approach is better. A little bit of knowledge, good execution, you can't go wrong. Look, I spent 20 years chasing passive income and I learned a fair amount and basically what a big rort it can be. So check out this video. I think you'll enjoy it.